So the good news is, as you watch this video, don't really overthink everything and don't think you need to know every single investment term out there. I know people that know so much more about investing than I do, and they have worse performances than I do, and they don't really invest as much as I do. Because investing is not really about knowing that much, it's actually about the application of information at the right times. Now, it's not to talk about time in the market, that's a different topic, and I don't really believe in that stuff, but what I mean is this, okay? You can know everything about a car, all the names of every single part, but if you cannot drive the car, what is the point of having all the information? My point is this: in this video, I'm gonna give you 12 terms that are very important when it comes to investments, and basically just understand the basics of it. But overall, understand the basics is one thing, understand terminology is another thing, the terms, all the stuff is cool stuff, but at the end of the day, what matters most is having a very good strategy, invest your money over the long run, and just allowing compound interest to make it's good on its promise. I think that's basically about it when it comes to investing. It's not that complicated at all. As always, guys, like this video, and top out, also subscribe and hit the bell so you get notified. Now, the very first term I want to talk about is basically whenever you hear Wall Street, what exactly is Wall Street? People think, hey, you know, Wall Street is doing this, Wall Street is doing that, okay? When you hear this term, especially for example from investors like Warren Buffett, they're not really referring to Wall Street like the actual street in New York and all those brokers and so on. Usually they're referring to basically investors as a whole. The actual people that are making investments, the actual masses. So when they say like, oh, Wall Street's going insane, they think basically prices are gonna go up forever. That's basically what they're talking about. Wall Street are the common investors, the masses overall, okay? Now, people can use it as saying, hey, Wall Street might be the brokers and everybody else making those big investments, the institutions and so on, but usually it's just referring to the masses. The masses, the masses. Now, number two is bear market versus a bull market. Now, it's not like, for example, a bear market is good. It's not like, for example, a bull market is awesome. But overall, I explain it the easiest way possible. Think about a bear market when prices are at a discount. Think about a bull market when things are selling for its current price or, for example, a lot more than it should be selling for. Now, it's complicated, right? Because you might say, Tommy, how do I know when a stock is selling below its actual price? And how do I know when a stock is basically selling for over? The answer is simple. You will hear the news on Wall Street a lot of the times. But if you want to be an investor, you got to know how to value a company. And that's how you basically know. And overall, it's very simple. A bear market is when Wall Street overall isn't really that investment. Okay, they're basically selling a lot. Okay, they're basically saying, hey, the market's going down. We gotta sell, and that makes prices go down, down, down. Now, it's not to say that just because a stock went from $1 to 50 cents that is actually a buy now. No, it's a lot more complicated than that, and that's why it's so important you learn how to value a company. More on that later in this video. And whenever you hear a bull market, it's whenever Wall Street is saying, hey, it's a great time to make money, and you see a lot of people basically buying and buying and buying and buying. We saw a little bull market, for example, during the pandemic. People were buying like crazy, and then we saw a little bear market like right now, okay? People are not really buying that much. The market's depressed, and it's kind of like a bear market, okay? That's the overall idea. Now, number three is a depression. You also have, for example, like various terms here. You have, for example, where you hit a bear market, which can cause a recession, which can eventually cause, for example, a depression. A depression is not good, and it's kind of like when you have two things that happen. When the Federal Reserve, they try to basically stimulate the economy, but it's actually not working. Unemployment is rising, the economy is slowing down. Think about a depression, kind of like saying, hey, things are not looking good, and that's not actually what you want. Like, it's not good. Look up, for example, the 1929 depression, and look up those pictures, and that's what it looks like when you have a real depression. We haven't had something like that before, and I don't think we probably will, like people basically making lines to get soup and so on, and unemployment being so high, because we do have a much better economy today. But that is a depression. You have recession, which is basically like a depression, but a lot less than that. It's kind of like, hey, things are not looking that great, economy slowing down, and depression is kind of like, yo, things are definitely not great, and this is not good, okay? Now, number 4 is opportunity cost. This right here is very important, and I'm not gonna make it that complicated. Opportunity cost is basically when you make one investment, what would have it cost you if you had made, for example, another investment? So if I made an investment into a stock that pays me 10% a year, and I basically forbade or just didn't invest into another stock that maybe, for example, 15% a year with the same level of risk, the answer is I had an opportunity cost of around 5% because I could have made more money somewhere else. But again, it's complicated because it's not that simple because returns cannot be calculated like that. So it's kind of like, for example, a better example would be, hey, what is the opportunity cost of your cash sitting in your bank account, making you like 0% versus you putting that money to work in the stock market, maybe for example, in an index fund? The answer would be, hey, somewhere around 11% a year, because again, index funds, for example, like the S&P 500, they might earn you about, for example, 11% a year, according to 72 years of data. Now, this makes me think about something else, is basically index investing versus mutual funds, which is kind of like weird because mutual funds are, well, index funds are a type of mutual fund, okay? But you have active mutual funds and then you have, for example, index mutual funds. Now, let me explain this because I did not add that to my list, but I kind of thought about it right now. An index fund is basically a fund where people basically pull their money together and they invest into certain things. But the overall goal is to track the overall market. So if we're trying to track the Standard & Poor's 500, which is basically the 500 largest companies in the US, they create this fund with these 500 companies and you put your money in there and they're just trying to mirror exactly what's going on with those investments. That's it. But whenever you put your money into an actively held mutual fund, you have investors that are basically trying to outperform the market by making, for example, different investments and so on. So one is trying to beat the market, the other one is just trying to mirror the market. One, because it has experts and so on, usually costs more money as far as commissions and so on. A commission is something that is usually charged to you for being a part of the investment. Commissions here, or for example, expense ratios, which is just, for example, how much it costs you overall to actually hold this fund, are usually a lot lower when it comes to the index side than it is, for example, to the active side. And overall, it's so hard to beat the overall market that usually you're better off just putting your money into an index fund instead of an actively held mutual fund, and they're very expensive too. Then you have, for example, ROI, which stands for return on your investment. This right here is super important and it's layered with different parts of finance here, because when you think about a return on your investment, you think that any return is a positive return, but overall it's actually not, because you have, for example, to take into account taxes, inflation, and also fees associated with you, also opportunity costs with you actually making an investment and having a return on your investment, which basically means, okay, if I were to have $100 and you offer me an investment that says, hey, you're gonna make 3% a year and there's actually gonna be no risk, the answer would be like, I don't wanna make that investment, because in reality, inflation, which is the value of my money basically losing buying power every single year, goes down on average by 3%, which basically means your 3% that you're paying me is actually being lost by inflation, so I'm actually breaking even. Nothing's actually happening. On top of that, if you offer me 5%, but then I have to pay 2% in taxes or 1% in taxes, the answer is it wouldn't be a good deal either. And then you have, for example, taxes and inflation, and then you say, hey, well, what about 7%? But then you have, for example, the fees associated with actually holding that investment. Well, it might not be that great either. So and then you have, for example, hey, what about 9%? Then you might say, well, I could just put my money into the S&P 500 index fund, earn 12%, and then again, that is opportunity cost. So there are a bunch of different layers when it comes to return on invested capital. And the overall idea is your capital, which by the way is the money you actually hold, which is capital, just money. Your capital has to give you a positive return once you take into account, for example, inflation, taxes, and fees, and opportunity costs. That's the overall idea. And you should know all those things. Taxes, you know. Opportunity costs, you know, inflation I just told you, and basically fees, we all know what fees basically are. Then you have, for example, compound interest. I don't even know myself like the actual terminology for it, but compound interest in simplicity is just your money earning more money on its money. And it sounds very stupid, but that's actually what it is. So if you have an investment of $100 and you earn 10% every single year of that investment and it compounds, it basically means that, hey, $100, the first year you earn 10%, which is basically $10, but then because you earn 10% on $110, you basically earn more money. So instead of making $10 that year, well, you're actually gonna earn around $11. And then it kind of goes on top of that. Then 10% of $111 is more, and then more and more and more. Basically saying, As long as you allow your money to basically have more money on it, to basically earn money on its money, you get to earn a lot more overall. And compounding is such a powerful thing. It's how you turn, for example, a simple $600 or $500 investment per month over 20, 30 years into almost $1 million, even though you didn't invest a fraction of that money. Just because you have your earnings, earn more on top of those earnings. That is compound interest, and that is one of the 7 wonders of this planet. It is so powerful, but it also works backwards, because it also means that the money you spend on stupid stuff is also being compounded negatively, because that's money you could have invested somewhere else, and that's also what? Opportunity costs, right? But if you try to think like this all the time, you will go crazy. So you have to be very careful, because at a certain point, anything I spent money on, I was like, this is crazy, because this is costing me actually this much and that much, right? Because you say, for example, hey, if I buy this pair of shoes, it costs $100, but if I invested that money at 10% over 30 years, that would actually be around $3,000. So what's going on here? Like, I can't buy this, like, you know, you go crazy. So it's very important. You just set aside money for investing and money for spending, and you don't go crazy overthinking all this stuff. Then you have, for example, dividend. Dividend is super important. You have dividend rate, dividend yield, but the most important thing to understand is that dividend is whenever a company gives you a portion of the profits in a distribution. You actually get distribution is just you getting something. So I'm using a lot of terms. I'm sorry about that, guys, okay? But overall, a dividend is whenever, for example, I have a company, the company made $100, and then I choose to give you guys a dividend of $50, okay? That's a share of the profits. You get a share of the profits. But whenever you get a dividend, you're not getting anything you didn't have before. That's what a lot of people and investors don't really understand, okay? Because when you do become a stockholder, which basically means, again, you own a part of the company, you're basically an owner of the company overall. So think about when you're buying a stock, you're buying a business. You're actually an owner. It's not a piece of paper or anything like that. No, you're actually a business owner. You're a part owner. So, for example, if me and you own a business together and our business made $100 and I decided to give you $50 distribution, like an actual income, you didn't give me anything. It's still my money. It's still a part of the business. I still own the business. That money should be in there, or whether I have it in my hand, doesn't matter. Now, the reason dividend is so important is because you have to think about return on your invested capital, or return on retained capital by this company. Now, retained capital is whenever a company chooses to retain the money in order to invest it to make more money. Now, the problem is if you're investing money into a business and this business doesn't have, for example, a good return on capital, then you might say, hey, let me get that money for myself as a dividend so I can invest it somewhere else and actually have a better benefit. Basically saying, hey, if I'm putting money into your business and you're basically earning, for example, 5% on that capital, well, no, give it back to me in a dividend and I'll grab that money and basically put it to work somewhere else. That's the overall idea. So you got to think about it like that when it comes to all this stuff, okay? So dividend, it's great, but it really shouldn't make you want to buy a company, because you still own the company. The profits are still yours. You just got to make sure that the company is not retaining money when it's not earning you enough money on that money. Remember, when you have opportunity costs, when you have return on invested capital, you got to think about fees, and you have to think about inflation and all this stuff. All that stuff is very important. Then you have, for example, number 8 here. I stopped losing track of the numbers because every time I keep talking, I find another word and I keep telling you guys, so I just want to break it down as thoroughly as I basically can. But overall, you have value investor, speculator, and also a index investor. Index investor, you should already know, because an index fund is just a fund where people are trying to track things. So if you're an index investor, you're basically just putting your money in there. A speculator is someone that invests into a company, but they're basically just hoping that it actually makes some money, and they don't have all the facts together, and the future is something they're basically very unaware of, right? Or they're hoping that the company makes some extra money, but there are no physical facts to actually support that concept. So it's kind of like, I want to invest into Bitcoin because I think Bitcoin is going to do great because my friend earns her money on Bitcoin. That's speculating, because you don't actually know that's going to happen. But when you have a value investor, for example, it's someone that invests money based on quantitative facts and qualitative facts, and their overall goal is capital preservation and also making a decent return on their capital. Very simple. That should make a lot of sense because you understand all these terms. But the idea is, if I'm a value investor, I want to buy a company where I fully understand it, I comprehend it, and I'm buying it, for example, at a fair price. I don't want to buy a Tesla that might be selling, for example, at 100-time earnings, something like that crazy, and it makes no sense because I don't know if Tesla's going to be like the #1 car company forever or whatever, right? So value investors invest based on facts, both quantitative and qualitative. Quantitative facts are basically like the numbers. Qualitative are more, for example, like how's the management, how's the customer service, and so on, right? So it's kind of like more like fuzzy stuff here and there when it comes to qualitative stuff. Then you have, for example, number 9, which is basically short selling and long selling, or whatever you want to call it. But short selling, it can kind of sound very difficult to understand, but the way it was broken down to me is whenever you think a stock is going to go down in price, so you basically short it. Now, what that means is, let's say, for example, I'm your neighbor, and I go to your house, and I'm like, hey, can I borrow your lawnmower? And you're like, sure. Now, your lawnmower is worth about $100, but I think there's going to be a sale, and it's actually going to go down to around $50. So I go ahead and I sell your lawnmower short. So I borrow the lawnmower from you, and I go ahead and I sell it instantly for $100. I take the $100, and then in a few months or in a few days, I basically buy another lawnmower for $50, give you back your lawnmower, and I keep the difference of $50. So in terms of stocks, it's like you buy a stock, you sell it right away, you have the money there. If the stock goes down, you rebuy it at a lower price and you keep the difference. That's selling short. The opposite would be selling it long, where you basically think that, hey, it's actually going to do the opposite. I'm going to buy right now and then I'm going to sell it later for a higher price or whatever. That's the idea. It's like the opposite. Now, the risky thing about this is obviously that you're speculating, because how the heck do you know if a stock is going to go up or down in the next like few weeks? Okay, it's very hard to do. It's impossible to do. If people could do this, like, they will be basically the richest people in the world. And people like Warren Buffett say it's not possible, and it's like very tricky. It's very speculative, and that's why I just don't play games where the odds are not in my favor. Then you have, for example, number 10, which is short versus long-term capital gains. This is actually very important. Now, I graduated as an accountant, so it's kind of like very simple, basic stuff. But the overall idea is capital gains is whenever you make money on an investment, right? If you have actual profit. You can also have a capital loss, by the way, which you can deduct against your income. But in stocks, you can only deduct up to $3,000, but you can carry over those losses for infinity. Now, what this basically means is, let's say you bought a stock and you basically bought it for $100. In a month, it went up to, for example, $200. You sold it, you have a $100 profit. Boom. That is short-term capital gains because you bought and sold the stock within 1 year, okay? Which basically means that that income is carried over into your normal, ordinary income, and you usually get taxed at a higher rate. Now, long-term capital gains would be, hey, I bought a stock at $100, I waited 1 year plus 1 day, then I sold it at $200. That $100 would be basically taxed as long-term capital gains between 0%, 15% and 20% max. That is the cap on it. But remember, when it comes to ordinary income, the cap is about 37%, if I'm not mistaken, which basically means you get taxed a lot higher over there. So that's why all of my investments, they're basically, for example, long-term, because it's just more efficient also when it comes to taxes. Then you also have, for example, qualified dividends and unqualified dividends, which basically means the exact same thing as far as, for example, like long-term capital gains or long-term capital gains. Basically meaning if your dividends have been coming in for over a year, you're not really collecting them, whatever, like you actually get taxed on them at a different rate. And that's why dividends are so tricky, because they also get taxed when you get distributed them, okay? If it's non-qualified dividends, guess what? You get taxed as ordinary income. That's also very important stuff when it comes to taxes. Then you have, for example, buy the dip. This is a term you're gonna hear a lot. This is a very stupid term, honestly. So buy the dip basically means stocks are down and you should go ahead and buy it because they're selling at a discount. You can't say something is selling at a discount if you don't know how to value a company. So valuing a company is very simple to do in concept, but it's very hard to do because it's very boring and it takes a lot of work and a lot of research to actually fully understand it. I would say valuing a company has like 3 steps. The first thing is understanding fully what the company is all about, how it makes its money, how it has protection, then basically quantifying exactly, well, how much money can I get at this business, and then is basically buying it below that to actually have a margin of safety. Now, what this basically means is if I'm trying to value a chicken, right? And the chicken makes me eggs. That would be the profits, right? So what would I want to know here? I would want to know exactly how many eggs is this chicken going to lay between now until I basically have to chop his head up in like 10 years or whatever. So that basically means that if in 10 years, this chicken's gonna give me, for example, 100 eggs, well, what are those 100 eggs actually worth today? And the answer is you have to discount those cash flows or discount those eggs. That's actually terminology. And discounting cash flows is based on, for example, if I can earn 10% right now somewhere else, again, opportunity cost, well, how much money is it cost me having to wait to actually receive that money 10 years into the future? Because again, $100 received 10 years from now is not the same as $100 today in your pocket. Now, that's where you come into the valuation of a company, because you're trying to figure out exactly how much money or how much cash flow is this company going to produce for me, the investor, over the life of the company. And you have, for example, a terminal value formula. You have, for example, it's a little complicated, so I'll basically won't tell you about it, but there's a great book on it. And I actually have it right here that breaks it down a little better than any other book I've seen. And it's this one right here, The Warren Buffett Way. You know, you have, for example, like The Intelligent Investor, great book, and also, for example, Uncommon Profits, Uncommon Stocks, or whatever. But this book right here breaks down, for example, what I just told you, a lot more simple, and it actually gets into a lot more detail. So that's a book if you want to read it. Now, then you have, for example, number 12, which is hyperinflation. Again, inflation is a dollar or your currency losing like its buying power every single year. It's the reason why when you were a kid, you can buy a bag of Doritos for like 25 cents, but now it's like $1. Like your money's not worth what it used to. We all see that stuff happening, right? Prices go up and up and up, and it feels like your money is just not worth as much as it used to be. So hyperinflation is whenever you usually hit like double digits, and it gets like very, very, very scary. Because you think about it, if your income stays the same, but then your money is worth less and less and less, it kind of means like you're actually receiving less money overall. And that's the scary part, because your savings also lose a ton of value. And that's why it's so important you invest money and you don't try to hoard cash. The only cash I ever keep is cash, for example, for things I really need, like my emergency fund, my sinking fund, and maybe like a preservative fund just in case something does happen and I have some payments to actually make, okay? But cash, just having it there sitting, is very dangerous in the sense that it doesn't make you any money and it's actually costing you opportunities. Again, opportunity cost. Everything around investments is opportunity cost. Everything is just opportunity cost. You're basically just collecting investments, you're constantly comparing them to other ones, and you're trying to find the best rational decisions to basically make. And that's what investing basically is. Then you have, for example, number 13, which is Fed rates. I keep saying, for example, I noticed that, I'm sorry. Fed rates, okay? So the Fed goes ahead and they set the rates. They're very important. So the Fed is kind of like saying, like, it kind of picks exactly at what rate banks are going to lend each other money and also what rate they're going to lend the banks money. And this is very important because if the Fed is lending money at 7%, that means the bank has to lend money more expensive to actually be able to make money on the spread. Basically saying like, hey, if the Fed is gonna make like you borrow the money at 7% and I have to lend this money out and there's also risk associated and all this other stuff, then I gotta lend this money like 10%, and it becomes more expensive for us to borrow money. But if the Fed is lending money out at 0%, which is basically free money, the answer is banks can lend us money a lot cheaper. And you might say, why is this so important? Why does it matter? How does it affect stocks, and why do I want to know this? It affects everything, because if it becomes more expensive to borrow money, then the economy tends to slow down because people tend to borrow less money and buy less stuff, and then businesses don't sell that much stuff and they basically have to cancel out employees. It affects everything and it trickles down. And trickling down is whenever one thing at the top tends to affect everything else at the bottom. And it's interesting. I love finance, I love money, and that's why I started out with 12 on this list or 13, and I don't even know how far I've gotten with all these terminologies. But overall, you gotta understand that as far as like learning all this stuff, it's interesting stuff. It's awesome. And if you're interested, it'll be cool. If you're not, it'll be boring. For me, it's not boring. It's actually fun. It's amazing. But the overall idea is, it's not that I'm smart. It takes time to learn this stuff, but overall, it really doesn't matter. What really matters is that you pick an investment strategy that makes sense. And my investment strategy, believe it or not, is just one index fund. I put my money into the S&P 500 and I basically invest a good chunk of my income in that, and I leave it in there for like ever. And I do it every single month to basically dollar cost average. Oh, dollar cost average is also very important, right? So dollar cost average, rebalancing. Wow, I missed a few things, right? Portfolio, I missed a lot of things, honestly. So portfolio is a collection of stocks. So if you have, for example, 10 stocks, that's a portfolio. 2 stocks, portfolio. 1 stock, that's just 1 stock, okay? Rebalancing is whenever you have, for example, your portfolio, right? And you want to keep an appropriate amount of distribution. So you might say, I want to have 50% bonds and 50% stocks. So you might say, I want to keep it like that. So whenever you rebalance, like sell some stocks to buy some bonds to get the balance, that's rebalancing. And dollar cost average is whenever you say, well, I want to make sure I buy at an average price. So what you basically do is you basically buy all the time every month to actually make sure at the end of the year you get the average, right, of the actual price. That's basically it. It's not that complicated. So overall, my investment strategy is that simple. I have one investment. I invest the same amount of money every single month, allow that money to grow, compound over time, and I basically, whether the market's up, whether the market's down, whether Wall Street's excited or not excited, don't care, just put the same amount of money in there and I buy at an average price. And over time, that gets me average returns in that portfolio, which basically means I earn 11% or 11.88% if I want to be exact over the past 72 years or so. But guys, that is it, okay? If you let me speak, I will be here forever, okay? Because I love these types of videos. But as always, guys, thanks for watching. Like, subscribe, hit the bell so you get notified. And if you made it all the way to the end of the video, comment down below, got it. If you got it. If you didn't get it, comment down below, I didn't get it. I need more help, okay? And watch this video again, write things down. And again, don't try to learn the actual terminology. Just try to understand what it means. You know, if I try to tell you word for word what the actual vocabulary terminology is, I won't be able to tell you, but I understand it. So try to put things like my teacher used to tell me all the time back in college or high school, I don't know, but told me all the time, Tommy, you have to learn how to put things in your own words. That's how you know you actually understand it. But that's it, guys. Up here is another video. Over here's my face. Click subscribe. And as always, Long-Term Team officially out. Oh, broker. That's the person that executes the trades on your behalf.